The difference between a $100 and a $1 million strategy isn't more confidence, other time frame, or some secret entry profitable traders know and you don't. Four things separate them, and the fourth decides whether you keep the big account or hand it back. Making these changes allowed me to go full time, and it helped dozens of other traders to grow from losing to payouts. But miss one and you will never be able to keep even a 100k funded account. Pull up the backtest of a trader who has never had a funded account longer than 2 months. It's beautiful. Clean equity curve, shallow drawdowns, then he goes live and the same setup stops paying. He assumed the market changed, but obviously it didn't. And nobody finds this out at $100. You find it out on a 200k funded account where the drawdown limit is a fixed number and it doesn't care what your backtest look like. Because most filters in that backtest got added the same way. He looked at his losers, found something they had in common and wrote a rule against it. No Fridays. Skip the first hour. Higher time frame has to agree. So the setup needs more confirmations than a bank loan. But each rule made the curve better, and each rule was true about the past. The curve hides what those improvements cost. Start with 300 trades. Cut Fridays and you are at 240. And the session filter, 170. Add the higher time frame rule, 95. He is now judging a system on 95 trades and calling it proven, and every one of those 95 survived because it already worked. So no warning ever comes. Live trading is the first time that system meets conditions it wasn't built from. And by then, he would size up the risk because the backtest told him it was safe. The $1 million traders runs it backwards. He doesn't ask which rule make the backtest better. He asks which rule would still be there if we had never seen the last 3 years. So removed each rule and rerun the data. If the expected value, drawdown and losing streaks barely change, the rule was never protecting the edge. Everything that only worked in the past comes out. The curve gets uglier, but the account stops dying at scale. Because the goal was never the prettiest backtest. It was the edge that still holds when the market stops behaving like a dream. So now the system survives contact with real data, but it still has to survive contact with hard limits you can't avoid. 2 traders passed the same challenge in the same week. Same firm, same 200k account. One runs a system that averaged 8% a month. The other runs one that averaged 4%. 4 months later, the 8% trader is buying another challenge. The 4% trader has taken 3 payouts. Nobody got lucky. Nobody broke a rule. And if you can't see what separated them, you will choose exactly what the first trader chose. The 8% system had a 12% maximum drawdown. He saw it, but didn't care too much because the 12% drawdown in his data eventually recovered. But the firm's line is 10%. And the strategy won't be able to recover. But he never even has to reach the limit for the system to disappear. At 8% down, he's staring at minus 60k, and that's where the hands starts moving. Cut the size, skip the entry. And from there, the system averaging 8% a month isn't the system running the account anymore. Take a strategy with 40% win rate. Over a large enough sample, 8 losses in a row aren't a freak event. They are normal variance. At 1% risk, that's 8% drawdown. On $100, that's $8. On 1 million, it's 80k. And 1 million as prop firm capital is not hard to get nowadays. So, do you see the difference? Both edges are real. Both pays out over 200 trades, but only one of them gets 200 trades. So if you want to trade with actual big accounts, you don't optimize the return first. You optimize the drawdown, because only the surviving account gets to collect the return. But an account can clear every drawdown in theory and still be gone within a year. For a reason no backtest contains. See, nobody decides to quit a system that works. A trader will tell you he refined it, that conditions changed, that he found something cleaner. Put the journal and the system is fully there in month 1. Thinner by month 4, gone by month 9. And he can't name the week he left it. By the time he realizes what happened, he may have already given the process 2 more years and spent thousands on lost challenges. And if you are sitting on a system you changed enough times that you couldn't say what's left of the original, that's exactly what we built a free 21-day trading reset for. Over 60 lessons, community and personalized troubleshooting to find the part that's breaking and walk you out of it for free. So let's do some math. Say the system gives 20 setups a month. That's 240 a year, and the edge was measured across all 240. In reality, he takes 16 a month. Some he sleeps through, some happen while he's a meeting, some he sees and decides today isn't the day. That's 48 trades gone before anything visibly goes wrong. Every backtest assumes the trader took every trade. He's comparing his live results to a number produced by a version of him who was never real. And those trades don't disappear randomly from the calendar. They disappear after 2 losses at the end of a bad week. On the Friday, he already feels behind. Now his live results and his backtest results are completely different. And none of it is obvious. There is no rule broken, no drawdown breach, no loss to review. The account simply underperforms, so he goes looking for a better one. And the time the system demands makes it worse. Take 2 strategies. The first averages 8% a month on paper and needs 6 hours at the charts every day. That's roughly 120 hours a month. The second averages 5%, runs on alerts, limit orders and fixed management and needs 20 minutes a day. That's under 7 hours a month. The first makes 60% more in the backtest while demanding around 17 times more of his life. And getting from a smaller funnel account to actual big capital is 2-3 years of this, running the same boring thing while nothing interesting happens. A system that requires that much input doesn't get 3 years. It gets 6 to 8 months and a replacement. So the strategy that scales isn't the one with the best numbers in the data. It's the one still being run in year 3, because an edge only pays the trader who stays long enough to collect it. All 3 of these problems push the strategy toward the same final constraint, the one most traders already dismissed as beginner advice. Ask a trader about his system in a chat room and all 12 rules come out in order with the reasoning behind each one. Amazing. Put him in front of the entry with live drawdown behind him and he doesn't click. He files that under discipline and spends another year working on himself. A rule looks like a line in a document. Live? It's a question. And it gets asked every time price reaches the level. 12 rules across 20 setups a month is 240 judgments. And every one of them has a third answer available. Not yes, not no, almost. At $100, almost costs nothing, so he never learns it's there. Let's say he is $10,000 down. One rule is only 80% clear. Well, he isn't deciding whether the setup is valid. He's deciding whether he wants to be in the market at all. The rule is simply what he uses to sign off on the answer he already had. 12 rules create 12 places to do that. 3 creates 3. I learned this on my first funnel account. My strategy had around 12 confirmations and I thought I made it bulletproof. Long story short, the account was gone in weeks. When I reviewed the trades, the strategy hadn't failed. I had traded a slightly different version of it every time. So the question is simple. Could you make the exact same decision 10,000 times while one click moves 5 grand? If the answer changes depending on how focused, confident, tired or calm you feel that day, the strategy is too complicated to scale. So run the test. Delete every rule that only had because you had already seen the last 3 years. Lower the risk until the strategy's ordinary drawdown fits the prop firm rules. And delete every rule you won't still be executing in year 3 on a Friday you are tired and behind. Then count what remains. 3 things, maybe 4. The $1 million strategy isn't simple because simple performs better. It's simple because simplicity is what survived every constraint trading throws at you. A $100 strategy is built to look good in theory. A $1 million strategy is built to be run by a human under real conditions. And that is the whole difference. So now you got a simple strategy, but a pro firm can still easily kill it in sneaky ways. So watch this video next. You will know which firms let your edge through, what size account to buy, and the pace that takes you from one funnel account to a portfolio the firms would hate you to have.